Hi, welcome back to Accounting with Vernon, your journey for success for the Edexcel Corporate and Management Unit. We are discussing limited companies. So far, in my last content, I did explain to you about the share redemption. We spoke of why is it done, how is it done. Today, I'm going to take you through the journal entries. But before that, this is a thing that I'm doing to help students in Sri Lanka, Maldives, Qatar, around the world who are following Edexcel specification or doing any other accounting exam, maybe at their basic level, maybe at their advanced level, to understand about limited companies' capital structure. So it's a thing that I'm doing with a lot of dedication, and I expect the motivation from you. So if you have not subscribed my channels, please do subscribe it, share it, like it, and also send me your comments as to what you want done so I can give you better contents in future. Right, in my previous content I did explain about the redemption of shares. Today we are going to look at the journal entries of a redemption of shares. So we look at the journal entries, we have to know that any shares will be having, any shares to be redeemed or to be bought back, we need to follow what was the nominal value of the shares. Okay, what was the nominal value of the shares, what was the premium of the shares, is there going to be a fresh issue of shares, then comes the capital redemption reserve, which I'm going to touch today. I did touch it on my last explanation. Today I'm going to go a little bit detail into that. Right, the first thing they are going to do is we are going to transfer the nominal value of the shares being redeemed. We are going to transfer the nominal value of the shares being redeemed. When you transfer the nominal value of the shares being redeemed, you are going to debit your redeemable preference shares or your redeemable ordinary shares account. You are going to credit your share redemption account. Some students prefer to do it without share redemption. See, I would prefer to go with the basic structure of accounting. So I will go through the share redemption account. Transfer of nominal value, debit the redeemable preference shares account, and you credit your share redemption account. Premium on redemption. Shares could have been issued at a premium, then we should be very careful. If the shares have been issued at a premium, then we have to remove the share premium on the redemption. So therefore, we debit the share premium account. We debit the share premium account and we credit the share redemption account. So we remove the premium, we debit the share premium account, and we credit the share redemption account. Nominal value is done. Share premium is done. Very easy, isn't it? So accounting is easy if you focus and you understand. If you don't focus and you understand, then accounting becomes a headache. But with the proper guidance, you will do well in accounting. Right, the third one. Nominal value done, share premium done. Now you can redeem your shares. When you redeem in the shares or you redeem your shares, there's a cash outflow. You credit your bank and you pay the money, the nominal value and the share premium. So you debit your share redemption account and you credit your bank account. You debit your share redemption account and you credit your bank account. Now, in this particular journal entries, I have assumed that the company hasn't had a fresh issue of shares. The company has not had a fresh issue of shares. It has utilized the existing cash resources. When that is done, we have a problem, isn't it? So the Companies Act restricts or prohibits or says if you are doing it like that, you have to protect your trade payables. You have to create the capital redemption reserve. How do you create the capital redemption reserve is, in my previous content I did say to you, if a company redeems shares without a fresh issue of shares, you have to create your CRR for an amount equal to, the nominal value of the shares for an amount equal to the nominal value of the shares redeemed. So CRR has to be created when there is no fresh issue of shares in order to protect your trade payables. It works as a creditor's buffer equals the nominal value of the shares redeemed. Therefore, in this question, I'm assuming that in my journal entries, there was no fresh issue of shares. Therefore, simple. I'm going to create a CRR. How? I'm going to debit my retained earnings for an amount equal to the nominal value, and I'm going to create the CRR. Four simple journal entries explain. Nominal value transferred. You debit your redeemable preference shares or your redeemable ordinary shares. You credit your share redemption. Premium on redemption, take it out of the premium. Share premium is always credit with the balance. When you remove it, your share premium has to be debit. Your share redemption is going to be credit. Third entry is pay the money. Share redemption account is going to be debit. Bank is credit. There was no fresh issue. The Companies Act says if there was no fresh issue of shares, then you have to protect your trade payables. You have to create a CRR. If you are going to create your CRR has to be equal to the nominal value of the shares being redeemed. CRR has to be equal to the nominal value of the shares redeemed. Therefore, I create my CRR by debiting my retained earnings. I debit my retained earnings, so I debit my retained earnings and I credit my CRR for an amount equal to the nominal value. Right. CRR. CRR is going to be very important because it protects the trade payable. It's a requirement. It's a compliance of the Companies Act. If you are redeeming your shares out of profits, you don't have a fresh issue of shares, you have to create the CRR. There are some issues regarding the CRR, what it can be used for. The capital redemption reserve it's a capital reserve. It's a capital reserve. So one of the main uses of the capital redemption reserve is we can use this for a bonus issue of shares. We can use this for a bonus issue of shares. Very simple, isn't it? You had a share redemption. There was no fresh issue of shares. You have posted all the transactions in the account and now you come across a CRR. Why? Because the shares were redeemed without a fresh issue of shares. There was no fresh issue. There was no cash inflow. There was no cash inflow. You have utilized your existing cash resources to buy back the shares, which creates a problem for the existing trade payables. Because of that, the Companies Act says to create a CRR equal to the nominal value. We have created a CRR by debiting our retained earnings and crediting the CRR. This CRR can be used for a bonus issue of shares. Simple to understand, easy to do, isn't it so? Right. So that was the redemption of shares. If you have not subscribed my channel, please do subscribe it, share it with others. Do like it and also post your comments for what you want done. Stay tuned. The next content is going to be on a much broad area, a big question based on the public issue of shares, bonus issue of shares, rights issue of shares, and a redemption of shares. Stay tuned. Thank you very much, and I wish you all the best.